Today, I'll continue to discuss the stock market. Recently, China and Hong Kong's stock markets have seen unusual volatility with a sudden surge from a prolonged slump into a frenzied bull market. However, right after National Day's holiday, the markets began to decline again following a zigzag pattern of sharp drops, brief rebounds, and more steep declines. The transition from bull to bear in China's stock market is not yet complete, and the story is far from over. For the average retail investor, it's impossible to time the market, whether it goes up or down. Since China's stock market is tightly regulated and controlled by the government is always the ultimate winner. The only difference is whether the harvest is quick and sudden or drawn out over time. In the end, the stock market in China will inevitably be left in disarray, making this topic no longer worth much discussion. However, there is one intriguing question. Why do so many Chinese investors, knowing the market is a trap, still jump in? The reasons behind this are quite fascinating, and today I'll dive into what exactly drives this behavior. Hi, I'm Dong Xiang. Welcome to Dig Into China, where we take a deeper look at China to reveal insights you can rarely find anywhere else. When we discuss stock market bubbles and the widespread craze for trading, it's easy to fall into the trap of attributing the frenzy solely to irrational investor behavior. In simple terms, this means that investors become overly enthusiastic and lose their rationality, causing abnormal price increases in the market. While this explanation may seem reasonable, it is ultimately superficial. Relying on the idea of irrational exuberance limits our ability to explore the issue more deeply. To achieve a more insightful analysis, we need to consider a comprehensive examination of the market's fundamentals. If we untangle the various causal chains behind the stock market, we'll discover that the seemingly irrational frenzy is, in fact, non-existent. Instead, it is rooted in rational calculations. The result is that everything operates in a systemic and orderly manner, revealing it to be a meticulously orchestrated financial scheme. Many economists have shared similar views. For instance, Peter Garber, in his well-known book, Famous First Bubble, expressed a comparable perspective. He wrote that, fascinated with the brilliance of grand speculative events, economists have huddled in the bubble interpretation and have neglected an examination of potential market fundamentals. The ready availability of a banal explanation of the tulip mania compared to its dominant position in the speculative pantheon of economics is stark evidence of how bubble and mania characterization have served to divert economists from understanding those outlying events highest in information content. Peter Garber's statement provides us with two key insights. First, we should analyze financial speculative bubbles through the lens of market fundamentals, offering a rational explanation that aligns with economic principles. Second, financial speculative bubbles are often not a result of irrational, haphazard investments. Rather, they are large-scale financial schemes designed from the top down. Therefore, the focus of our analysis should be on how this financial scheme operates. Analyzing from these two angles will lead to a more precise and in-depth understanding. In today's episode, I'll explore the current trend of stock market speculation in China through these two perspectives. Let's first look at the Chinese stock market from the perspective of market fundamentals. Recently, the Chinese government introduced a large-scale economic stimulus package, potentially totaling up to 2 trillion yuan, which has led many retail investors to open accounts and start trading stocks. Historically, such stimulus measures typically benefit financial institutions like banks and brokerage first, and this instance is no different. Market trends show that the bank stocks in mainland China have been performing strongly, with the securities sector also surpassing the broader market. But who are the clients of these banks and brokerages? These institutions rely on making profits from investors to sustain their operations. So the crucial question is, who are these investors in China? We need to understand this better. This screenshot presents a survey conducted by Databao, a subsidiary of the China Securities Journal. The findings reveal that the number of investor accounts in China's A-share market has exceeded 210 million, with the vast majority being retail investors and a very small percentage being institutional investors. It is evident that even today, China's stock market is still largely characterized by retail investors. The survey results show that these retail investors generally have lower educational qualifications, with over 50% holding degrees below the college level. In terms of age, the largest demographic group consists of middle-aged and older individuals, particularly those between 40 and 59 years old. Although the Chinese government has consistently promoted the idea of attracting younger investors and encouraging investment from an early age, the reality is that the stock market also faces an aging issue. So, what are the specific thoughts and behavioral characteristics of this demographic of older, less educated Chinese investors? Let's take a look at some relevant research. In the mainland Chinese journal Psychological Science, there is an article titled Behavioral and Personality Characteristics of Chinese Securities Investors. This study conducted a questionnaire survey to explore the collective psychology of Chinese stock investors. After surveying investors from 7 major cities in China, the researchers uncovered several key characteristics. First, most investors believe they have a good grasp of the operational conditions of investment companies. However, paradoxically, they lack trust in the financial data released by these companies, suspecting that the financial reports may be misleading or fraudulent. So, what do Chinese investors trust the most? According to survey results, their highest level of trust goes to government policies, with over 87% of investors believing that the national policies have the most significant impact on their investment decisions. This suggests that the Chinese stock market is fundamentally a policy-driven market. In such a market, it's not just that policies greatly influence market trends. More importantly, Chinese investors rely entirely on government policies for their investment choices rather than on market conditions. They have little faith in the market itself and prefer to trust the government. In reality, Chinese investors are mostly older individuals with lower educational backgrounds who place significant trust in the government. Given this demographic, their behavior in the market is quite predictable. From this angle, the widespread participation in stock trading and the frenzy surrounding it in China are not indicative of irrationality or excessive enthusiasm among the populace. Rather, they stem from rational calculations. The entire Chinese system, encompassing both official and grassroots levels, is working together to orchestrate a massive artificial stock market and a contrived bull market. Thus, these elements are mutually reinforcing. On one hand, the public has faith in the government. On the other, the government exploits its distrust to influence the people. Together, they have crafted a grand spectacle in the stock market. The so-called artificial bull market is just the initial step in a broader financial plan. What precisely does this financial plan entail, and where is it headed? Let's explore this topic further. The so-called artificial bull market is fundamentally based on the shared interests of the Xi Jinping government, financial bureaucrats, and foreign capital. This coalition represents the greatest common denominator of interests currently available to these 3 parties. What are the sources of their mutual interests and the profits? This question is not hard to answer. Clearly, the main driving force and the potential profit source for the artificial bull market come from the savings of the Chinese population, which amounts to a significant total asset base. According to reports from Yicai, the total amount of household savings in China has reached 145 trillion yuan. Additionally, the share of government and corporate deposits has been steadily decreasing, while the proportion of household deposits has been increasing, rising from 39% in 2016 to 48% last year. This trend suggests that the Chinese public has been saving aggressively in recent years. For many, this money likely serves as a crucial financial safety net. It's well known that China's high saving rate stems from low social welfare, which forces citizens to save on their own. For the government, however, this money represents idle funds sitting in the hands of the public, unused to its full potential. The government has long had its eye on these savings, with the official rhetoric being about leveraging household savings to revitalize the economy. In truth, this artificial bull market is a financial experiment aimed at using these savings to stimulate economic activity. Current market estimates suggest that China's latest economic stimulus package is around 2 trillion yuan. In other words, the government is aiming to use this 2 trillion as leverage to mobilize 145 trillion yuan in assets. It's a highly attractive strategy, given the significant return compared to the relatively low cost. As I previously mentioned, Chinese investors tend to place a great deal of trust in the government, often following its guidance when buying stocks. Additionally, they exhibit a strong willingness to take risks. However, this risk-taking doesn't signify courage. It reflects a lack of awareness and, for many, a sense of having no other options. Germany's Max Planck Institute for the Study of Societies published a report exploring the link between social class and risk tolerance in investments. Researchers conducted simulated investment experiments with groups of student and professional investors. The results showed that the non-professional student group tended to take greater risks, especially after being told who profited and who lost, leading to a strong herd mentality. On the other hand, the professional investors stayed composed, unaffected by such information, and consistently followed their own strategies. This behavior is likely a universal trait among non-professional investors. They don't have their own investment frameworks or strategies, and instead, they follow the crowd when it comes to buying or selling. Now, looking at the holders of China's 145 trillion yuan in savings, it's clear they fall into the non-professional category. In addition to their strong trust in the government, another key characteristic of Chinese investors is their lack of expertise and their tendency to follow the herd. In addition to these two aspects, the Chinese stock market exhibits another notable characteristic, the phenomenon of fear-driven investment, where stock prices rise due to investors acting out of fear. This unusual trend has been seen historically. Historically, the Shanghai stock market has experienced its strongest growth during wartime, particularly during the Second Sino-Japanese War and the Chinese Civil War. This occurrence, known as island prosperity, is attributed to the scarcity of viable investment opportunities amid the persistent fear of conflict, with rampant currency devaluation rendering traditional investments nearly futile. Not investing effectively equated to financial demise. Consequently, speculative capital in Chinese society had no option but to channel all its resources into the stock market, taking a significant gamble on this singular avenue. During times of war, Shanghai saw a surge in newly listed companies, the majority of which were merely shell corporations with no actual business activities, created solely for stock speculation. After driving up their stock prices, these companies would promptly vanish, taking investors' money with them. As a result, this fear-driven stock market ultimately preyed on and exploited everyday retail investors. The island prosperity seen in wartime Shanghai and the current fear-driven stock market share significant similarities. Today, Chinese citizens face a severe lack of investment options. The real estate market has entirely collapsed, making further investments there likely to result in losses. Options like cryptocurrencies, which are popular abroad, are also inaccessible. Additionally, the most reputable bonds and the top US tech stocks are out of reach for most Chinese investors. Consequently, mainland China is inundated with worthless assets, and the currency devaluation is occurring at a rapid pace. With strict regulations preventing capital from leaving the country, many Chinese feel trapped and have no choice but to gamble their fortunes in the stock market. Thus, the current mindset of Chinese stock investors can be summed up as follows. They have blind faith in the government, are eager to take risks, and feel they have no alternatives, leading them to place all their bets on the stock market. This is why, even though they know there is a pitfall ahead, they can only jump into the stock market. However, I believe that the Chinese Communist Party's financial authorities have been aware of these investors' trades for quite some time. Consequently, the Chinese government is adept at manipulating stock investors, fully controlling their actions and sentiments. I believe this artificial bull market is not yet finished. It will continue to experience fluctuations until all of the savings and money from retail investors are fully exploited. When this artificial bull market can no longer hold up and ultimately collapse, foreign investors who have recouped their losses will exit, and the major stockholders will relocate their funds away from the stock market. Financial bureaucrats and entrenched interests will also take their money and flee, leaving retail investors to absorb the final blow, which will certainly lead to the market's collapse. At the same time, Emperor Xi Jinping will express his outrage and call for a thorough investigation into financial corruption, demanding severe punishments. This indicates a new phase of purging and restructuring within the financial system, involving the arrest of certain individuals, punishment of others, and warning to the rest. This strategy not only refreshes the ranks of financial officials, but also acts as a spectacle for the Chinese public, suggesting that the Communist Party stands for justice for the people. This facade aims to placate the retail investors before gradually setting the stage for the next round of exploitation. In conclusion, the jagged cycle of exploitation in the Chinese stock market is far from finished. Retail investors will keep having their resources drained in ups and downs of stock prices. After watching this video, do you still think that Chinese investors are foolish or irrational? I believe you won't see it that way anymore. Chinese investors are neither foolish nor irrational. They are merely navigating a game against the government, striving for a glimmer of hope in a landscape devoid of real opportunities. It is as simple as that. Thus, if you assess the situation solely from an investment standpoint, you are fundamentally mistaken. The essence of the Chinese stock market is a mutual deception between the government and the public. But in the end, the government always wins. The public can never outsmart the government, no matter how hard they try to deceive. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, stay well.